welcome to the opening module of the course section devoted to consolidation workings, in which we shall be exploring the specific procedures for preparing group financial statements as dictated by IFRS 10, Consolidated Financial Statements, and IFRS 3, Business Combinations. In this video, we will be focusing on the consolidated statement of financial position, exploring in particular the circumstances which lead to the recognition of goodwill, as well as its opposite, that is a gain on a bargain purchase. We will be doing so with the aid of a comprehensive example, which we will commence without delay. Let us assume that P acquired the entire share capital of S for €8,000 when the statements of financial position of the two entities were as follows. And you can see some very simple statement of financial position data for both P and S. Note that within the assets of P, that's the parent entity, we see the investment in S, which has effectively become the subsidiary, reported at €8,000, the cost of acquisition. You should also note that the example contains two additional blank columns, which we will utilize to make consolidation adjustments and to present the ultimate consolidated statement of financial position. What I want to do is open up a T account, which will hopefully help us visualize the consolidation workings and their interaction with the items carried in the individual statements of P and S. The account which I will draw is referred to as the cost of control, whose function is to determine the amount of goodwill, if any, recognized in respect of the transaction. And to this account, I will immediately transfer the investment in S as reported within the assets of P. As we are effectively eliminating an asset, the adjustment constitutes a credit entry, whose corresponding debit appears within the cost of control account. To the same account, we will also transfer the share capital and reserves of the subsidiary as at the date of acquisition. So using the adjustments column, I will remove the €3,000 of S's share capital, as well as the €2,000 of its retained earnings. Eliminating items of equity means that the relevant entry takes the form of a debit, with the corresponding credit going once again to the cost of control account. We may now compute the balance of the cost of control account, seeing as the single debit entry is higher by €3,000 than the sum of the credit entries. The account has a closing debit balance of €3,000. This amount corresponds to the excess of the purchase price over the net assets of the acquired subsidiary and is referred to as goodwill. Goodwill is presented as a non-current asset in the consolidated statement of financial position, so let's insert it at the very top of the statement using the adjustments column to record the €3,000 of increase in assets. We may now complete the example by summing the items in the P&S columns, taking note of any adjustments which were made. So, in that final consolidated column, we will record the €3,000 positive adjustment made in respect of goodwill. Investment in S is now completely eliminated, so it does not feature in the consolidated column. Other assets are simply summed together to produce €16,000. Total consolidated assets therefore come in at €19,000. When it comes to the equity section, we are simply left with the share capital and retained earnings of the parent entity, so that's €9,000 and €6,000 respectively, with a total of €15,000. consolidated liabilities are the sum of 2,500 and 1,500, giving 4,000. When we total the consolidated equity and liability balances, we get a result of 19,000, which naturally equals the previously computed assets total. Let's take a moment to reflect on the effect of the operations which we have just performed and their impact on the consolidated financial statements. The investment in the subsidiary, as reported within the assets of the parent, has now been replaced by the subsidiary's individual assets and liabilities. At the same time, the cost of the investment in the subsidiary has effectively been offset against the subsidiary's share capital and reserves as at the date of acquisition, producing a difference referred to as goodwill. And finally, the share capital reported in the consolidated statement of financial position comprises the share capital of the parent company only. The goodwill recognized under non-current assets within the consolidated statement of financial position represents the excess of the purchase price over the value of the net assets of the acquired subsidiary. Accordingly, it may be thought of as corresponding to the future economic benefits associated with those resources acquired in the combination that are not individually identified and separately recognized, such as hoped for synergies or the reputation of the acquired business. Under IFRS, goodwill is treated as an intangible asset which is not subject to amortization. Instead, it must be tested for impairment on an annual basis in accordance with the rules laid out in IAS 38. It is important to stress that the assets and liabilities of the subsidiary are initially recognized in the consolidated statement of financial position using their fair values, which may not necessarily be reflected by their existing book values, in which case critical adjustments will in fact be required. Such adjustments may pertain to assets or liabilities which are already recognized in the subsidiary's standalone books, or assets that were previously omitted altogether, as is often the case with a brand or similar intangible assets, which the subsidiary generated internally. Let us therefore modify the previous example to include information on the fair value of the assets of S, making the assumption that S's other assets include an item of property whose fair value is in fact higher by €4,000 than its carrying amount. We may further assume that the fair values of the remaining assets and liabilities of the subsidiary are equal to their book values. The procedures required to produce a set of consolidated financial statements in this case would, to a large extent, follow the same logic as before. We would therefore need to set up the cost of control account, to which we would transfer the €8,000 of investment in S from the statement of financial position of the parent, as well as the share capital and retained earnings of the subsidiary as at the date of acquisition. This time, however, we would also need to make an additional adjustment to the other assets of S, which obviously include the property with a higher than reported fair value. Using the adjustments column, we would raise the carrying amount of those other assets, which effectively means performing a debit entry of €4,000 with the corresponding credit once again going to the cost of control account. You should appreciate that on one side of the cost of control account we have the price paid for S, and on the other side the book value of S's equity, in other words the book value of the subsidiary's net assets as at the date of acquisition. This figure is further adjusted upwards by €4,000 so as to make it correspond to the fair value of the subsidiary's net assets. With this adjustment in place, the entries on the credit side of the account are in fact larger by €1,000 than the purchase price paid, suggesting that the cost of the investment was less than the fair value of the net assets acquired. In such circumstances, IFRS 3 requires that the assessment of the fair values of the investee's assets and liabilities be reviewed for potential misstatements. If, following such a review, the cost of the investment still remains below the net asset fair value, the difference is credited to the consolidated income statement as a one-time gain on a bargain purchase, which is recognized at the date of acquisition. Accordingly, we may write that the missing €1,000 debit needed to balance the cost of control account has a corresponding credit within P&L, which in turn will have a positive 1,000 impact on consolidated retained earnings. Summing the entries in the PS and adjustments columns, we have no goodwill, no investment in S, other assets of 9.5 plus 6.5 plus 4,000, giving a consolidated total of €20,000, which also corresponds to total assets. Consolidated share capital is once again equal to €9,000, but retained earnings comprise the €6,000 coming from P, as well as the positive €1,000 adjustment to produce a total of €7,000 and a consolidated equity total of €16,000. Consolidated liabilities equal a further €4,000, bringing the total of equity and liabilities to €20,000. It is important to stress that in the above two examples, we were required to consolidate the subsidiary at the date of its acquisition. Accordingly, all of the subsidiaries' reported retained earnings were deemed to have been generated before the acquisition, causing them to be eliminated from the consolidated statement of financial position by means of transfer to the credit side of the cost of control account. If, however, the consolidation procedures were to have been performed at a date subsequent to the acquisition, then some of the subsidiaries' retained earnings would have been generated following the acquisition, and in such a case, those post-acquisition retained earnings would be included in the group retained earnings balance.